Hey there, estate planning attorney Paul Rabelais here. Another almost daily edition of Estate Planning Live. It's a YouTube live presentation. A couple of housekeeping rules before we jump into gift splitting between spouses. Hey there, Dasto from Indiana. Good to see some Indiana representation there. But a few quick items. If you're a channel subscriber and if you're watching, I do suggest that you subscribe to the channel, hit the notification bell so you don't miss anything. But all you subscribers are welcome and encouraged to provide some chat in the dialogue there. You can ask questions, you can comment. We do ask that you keep it positive and constructive. But when we really get going, we often see a lot of the people on the video here kind of chatting amongst themselves and giving each other advice, which is great. Establishes a little community here. And just know that as I talk about things here on the presentation, and as I address chat comments and questions, I'm not giving anybody one-on-one legal advice. There's no attorney-client relationship established. So yeah, I've been an estate planning attorney for about 31 years, been here on YouTube for 6, so glad to have everybody here. All right, so the main problem that we're going to focus on today is to set it up. First, let me talk about the gift and estate tax exclusion amount. Hey, Stephen from Texas. We don't know what it's going to do in the future. All we know is right now there's a $12.07 million estate tax exclusion amount, and genuinely it's going to per spouse. So if married couples set up things the right way, they get 2 of those exemption amounts. And as far as what will happen to that in the future, we know that it's on the books that exemption amount will be cut in half for deaths that occur on or after January 1st of 2026. So that's what's on the books now, but sometimes books change. And so Congress and the president may keep it at 12 or 13 million. They may just let that law sunset, which means the exemption will be cut in half to 6 million. Who knows? Maybe they'll reduce the exemption amount to 3 million or 1 million. The bottom line is nobody knows what it will be in the future. Nonetheless, there are many people out there who would like to move assets from within their estate, where those assets will be subject to a 40% federal estate tax based on the value of those assets when they pass away. Some people want to move assets from within their estate, subject to a 40%, to outside of their estate, where it all goes to the next generation free of the 40% federal estate tax. And for starters, a lot of people do that by making gifts to their children, either gifts that are outright, where the simplest form of an outright gift is writing a child a check for $10,000, $15,000, the $16,000 present interest annual exclusion amount, or by transferring those assets to a particular type of trust. Let's call it the crummy trust. I've done some other videos on that. And in order to preserve the present interest annual exclusion and to preserve those assets even after, and have a little more control over those assets even after those assets are taken out of your estate and moved into perhaps the estate of the next generation. So that's just a goal of many people, is to have themselves and their family pay as little tax as possible and move assets from a 40% tax to a 0% tax. Let's see here who we've got. Hi from South Texas, Lisa. Per spouse sounds okay only if you both pass away at the same time. Not necessarily if both pass away at the same time. So no, with something called the marital deduction and with something called portability, the portability election on an estate tax return of the first spouse to die. So, and these are all things I've talked about on other videos on my YouTube channel. In order for the couple to get 2 times the estate tax exemption, they don't necessarily have to pass away at the same time. Okay, so let's see. Hey, from California. Good to see you, Claire. All right. So we've established here that some people want to arrange their estate, move things from a 40% subject to a 40% estate tax, move it out of the estate so it'll be subject to 0 tax. Whether those assets are cash, or they are interests in a business, or they are publicly traded stock or securities, or whether that value is a membership interest in a limited liability company, there are people out there who, if you keep that in your estate, the fair market value of those items will be subject to a 40% tax. They want to get it out of the estate. However, sometimes you have a situation where one spouse has assets that they'd like to transfer to the next generation, and the other spouse doesn't have an ownership interest in that. We've talked about in other videos the $16,000 present interest annual exclusion. Hey, Carlos from Palm Springs, Southern California, good to see you there. We've talked a little bit about the $16,000 present interest annual exclusion, but if only one spouse owns those assets and they can only transfer $16,000 to as many people as they want to every year, they're really limited on how much they can get out of their estate. They just can't get it out of their estate fast enough. So you may have a scenario where one spouse owns assets that need to be what's called gifted, or maybe you have spouses in a second or third marriage. They each have their own children. One child wants to fairly aggressively do some gifting to get the assets out of the estate, but the other spouse doesn't want to gift to those same people because they each have children from prior marriages or relationships. So those spouses are often kind of stuck. They can only transfer $16,000 to people each year. They want to do more. Again, if you transfer more than $16,000 to anyone in any particular year, nobody owes any tax, but you start using your estate tax exclusion amount. So for example, if the exclusion amount was $12 million when you pass away, and you make a gift during your lifetime of $116,000 to your son or to your daughter or to someone, well, the first $16,000, that's okay. But the additional $100,000, well, nobody owes any tax, not even the person who received the gift. And the person who made the gift, they can't deduct anything on their personal return. But what happened by making that $116,000 gift, the donor, the person who made the gift, used up $100,000 of what I'll call their $12 million exemption. So now when that donor later passes away, they can only leave 11.9 million free of the federal estate tax. And I know some of you out there are saying, oh, only $11.9 million. And obviously this rule doesn't apply to everybody in America out there. But when it applies, it's a tough one, the estate tax. So anyway, that's the deal there. Okay, so the solution, Colorado. Nice to see you, Ann from Colorado. You know, I can see you. Your video thing is on. I'm just kidding. I can't see anybody who's talking in the chat. Thought you might get a kick out of that one, or somebody might. All right, so the solution to getting more out of the estate. Hey, from Florida. Good. Good. Working on a My Advocate plan, mirrored wills, but on hold. No one to name as a backup executor. Okay, got you. Good point there. Friend, relative, niece, nephew. So anyway, I'm sure you've explored several alternatives there. All right. And by the way, she's talking about an online estate planning platform website that I co-founded, started building it a couple of years ago when COVID hit, because the really only way and the traditional way people can get their affairs in order has been to go hire law firms and lawyers. And so with technology taking over everything, I wanted to take that attorney estate planning experience and move it online. Hence, that's what we did with My Advocate. I'll put the link for that in the description below, and it's in the link of other videos on my channel. So anyway, all right, so let me jump here, see if we have anything, because what I do is I like to jump to the chat and answer and address a few things, then get back to the content. Looks like we've got more California. California is well represented today in our YouTube Live. So that solution is when a married person wants to do some gifting, I'll call it, of their own assets, but they want to maximize what they can get out of their estate without using their exclusion amount, is gift splitting. So here's the way that works. Let's say wife has assets of her own. She may live in a community property state with, let's say, her husband, but maybe she owns separate property, things she earned and acquired before they got married. Maybe she has an inheritance that is her separate property. Maybe assets were gifted to her. That may be her separate property. or not in a community property state, but wife has assets and she wants to maximize what she can give to her future heirs. And she's thinking, geez, I can only give $16,000 a year. That's the present interest annual exclusion. I'm not going to be able to give it away fast enough. There's going to be a pile of 40% estate tax when I pass away. Well, she and her husband can take advantage of what's called gift splitting. So that wife can actually not give away only $16,000 without using her exclusion amount. She can give up to $32,000 of assets to as many people as she wants to every year. She's the only one doing the gifting. The only assets being gifted are her assets, but she can double up on that annual exclusion amount because her husband participates in the gift splitting. So the way that works is, hey, good. Janice Timely, good to see that. More California from Denise, great. Rita, Illinois, good to see you. Okay. So what happens is the wife, if she were to just transfer $16,000 to a whole bunch of people or one person, doesn't really matter, there would be no requirement that she file a gift tax return showing that she used some of her exclusion amount, because that first $16,000 that you give to as many people as you want to, you don't have to report that to the IRS. But the general rule is if a person donates more than $16,000 to anybody in any calendar year, then that donor, the person who made the gift, is responsible for filing an IRS Form 709, federal gift tax return, no taxes due, but the donor is now showing the IRS that they're using some of their estate tax exclusion amount. So no gift tax return is even required to be filed if someone makes gifts that don't exceed $16,000 in a calendar year. So what gift splitting does is that wife actually transfers $32,000 of value to as many people as she wants to every year. Now, she is required, in order to take advantage of the gift splitting, so she doesn't use any of her exclusion amount, she is required to file a gift tax return, again, IRS Form 709, and her spouse, let's call it in this case, her husband, the non-donor spouse, must also sign that return and provide their consent to split the gifts. So wife gave $32,000, let's call it, to all of her 4 children and 10 grandchildren. Wife made 14 gifts of $32,000. That's probably $500,000 or more in 1 year to enable that family to avoid the 40% tax on all of those assets when the wife passes away. And then so she files her gift tax return, and on that return, her husband signs and consents to allow his wife to use his $16,000 annual exclusion amount. So the gift splitting, it allows for gifts that are made by a spouse, in our situation of the wife, to be considered for tax purposes as made 1/2 by each spouse. So even though wife gave $32,000 to 14 different people, with gift splitting, those gifts, even though it came from all of wife's assets, are deemed to be coming 1/2 from wife and 1/2 from husband. Hence, neither one used any of their estate tax exclusion amount. That entire estate tax exclusion amount is preserved. So the gift splitting gives an advantage to the donor spouse, in our case, the wife, who will obtain the benefits of using the consenting spouse's annual exclusion. So it allows that donor spouse to double up on the annual amount that may be transferred without any gift tax and without using any of the annual exclusion amount. So you may be thinking $12 million exclusion amount, this doesn't apply to me, let me go watch a cat video. But really, with the upcoming reduction in the exclusion amount, people who today have maybe an estate worth $3 or $4 million, in 2026, and that's 4 years from now, they're likely to have a $6 million plus estate tax exemption. And so that's what the exemption is expected to be in, or is going to be in 2026, unless Congress takes other action. And so people, really the people who want to save the most tax will start now and doing some of that gifting. And so gift splitting may be appropriate, even though if you were to pass away, there's not a chance that any estate tax would be due. But people need to kind of look out for the future and consider starting this. You don't want to start any of, I don't want to say a general rule is you don't want to start any of that gifting until you are secure that you have an estate that is large enough and has the resources that can cover all of your needs for the rest of your lifetime. But there are people out there who say, you know what, my number or whatever is X. I'm well above my number, so I have enough. I live frugal. I know I'm going to have enough income. I know I have enough assets to live off of the rest of my lifetime. I can simply move those additional assets out of my estate, move them down to the next generation, either outright or in trust. And that way I'll be, and then after I move them out of my estate, those assets can be invested. They can continue to appreciate. So not only what's gifted, but all of the future appreciation from those assets would avoid the 40% tax. All right, so always want to remind people about the income tax consequences of gifting. A lot of people think if somebody makes a gift in excess of $16,000, somebody owes some income tax, but that's just flat out not the case. So a gift is not subject to income tax to the person who received the gift, doesn't have any income tax consequences to the person who made the gift. Again, I'm repeating myself for a second or third time here, but it's worth repeating because there's so much confusion out there. If you make a gift in excess of $16,000, nobody owes any income tax. You just use some of your estate tax exclusion amount, unless you're married and take advantage of gift splitting, where you can double that amount that you can transfer out of your estate to as many people as you want to every year. Okay, and just know that there are lots of particular rules in our regulations regarding if a spouse consents and then for some reason they want to revoke their consent. There's lots of rules about when someone, when the gift is made and then the consenting spouse passes away before they have an opportunity to file a gift tax return and consent to the spouse, rules on that as well. So there's a number of rules out there on these particular situations. But I just want you to be aware as the estate tax starts to come back into the fold with the reduction being cut in half, there's something available called gift splitting that really is going to allow married people to shift, really double the assets out of their estate, which would be subject to a 40% tax, to a situation where it won't be subject to the 40% tax. All right. How will inflation impact these calculations, Stacy? Seems like any money that is liquid right now is like sand slipping through fingers and may not last nearly as much as anticipated. Yeah, there's a lot of factors that go into some of these projections about how much tax will be saved, how much of an estate that you'll have in the estate, out of the estate. Inflation is a factor. Kind of projected compounding rates of growth are also a factor. That all goes into it. Good points there. All right, so be aware. I'm going to stick this in your brain. Be aware of the opportunity for gift splitting if you have a married couple and one spouse wants to max out their gifting, either because they have the bulk of the assets, or because that one spouse only wants to gift, for example, to their children, and that person's spouse doesn't have any interest in gifting their assets to the children of their spouse. Gift splitting is an awesome opportunity to allow that donating spouse to double up on their annual exclusion amount. All right, so keep up with your chat. I am excited about a couple of things here. One thing I'll be talking about next week. I haven't finalized the schedule, so I'll put it on the community tab of my YouTube channel when I have my schedule. But very excited next week about talking about the Secure Act, which is a couple of years old. Some regulations came out in the last couple of months. It's going to affect anybody who owns an IRA or anybody who's a beneficiary of an IRA. The stuff we talked about today, it's really affecting more the higher net worth folks. but there's going to be a lot of mistakes made in the future by beneficiaries of 401ks and traditional IRAs because they're not aware of all of the nuances involved in the Secure Act, which dictates when distributions must be made from retirement accounts after the retirement account owner dies. I'll be talking a lot next week about how IRA owners can set up their IRA now so that those beneficiaries don't get hit with a large lump sum tax bill, and how beneficiaries can spread out retirement account distributions and never be subject to income tax at the highest income tax rate. It used to be kind of automatic because IRAs were permitted to be stretched over, the distributions were permitted to be stretched over the lifetime of beneficiary. No more, a lot of new rules. And so I'm looking forward to sharing that with you and sharing some of my insight as well. Okay, Stacy, you're welcome for the videos. Glad you've been learning with the estate tax exemption projected to go down to 3.5 to 5 million in 2026. How is gift splitting beneficial from that perspective? Well, I'll give you an example. Kind of the far end is, let's say you have a husband, for example, with a $24 million estate, and a wife, she doesn't have much. She has, let's just call it nothing. Well, that husband then, and he's thinking, geez, and Pete's, it's Nazish is saying it may go down to 3.5 million. That means $20 million of his estate will be subject to a 40% tax. So what that husband, and this is kind of an extreme example, who has a $24 million estate might do, or maybe he has an estate worth much more than $24 million, but he could say, I'm going to go ahead and transfer $24 million down to the next generation, and my spouse is going to partake in gift splitting. And so that way, the husband with his current $12 million exemption was, and with that, those gifts being deemed made one half by the husband and one half by the wife. Now that husband was able to shift $24 million of value to the next generation, and done deal. And with the exemption in the future coming back to, as you say, 3.5 to 5 million, guess what? That husband just took $24 million and eliminated the 40% estate tax from taxing any of that. So, there is some opportunity there to get assets out of the estate prior to the exemption coming down. I don't know if that's what you were getting at. Appreciate IRA distribution. Yeah, Stacy, looking forward to sharing the IRA distribution rules. I'm really looking forward to that. Number one, it helps everybody. Number two, current estate planning, when people leave things in trust for people, the only benefit that one gets from that is a person who creates an estate plan just gets the peace of mind knowing that nobody's going to blow it. But now with the Secure Act and the IRA distribution rules, you have an opportunity to do two things. Number one, make sure nobody blows the IRA by getting it in one chunk at a 40 or 50% income tax rate. You have an opportunity to give them a stream of payments over the term that the Secure Act requires, and make sure that each of those payments doesn't get taxed at the highest income tax bracket. So anyway, looking forward to sharing a lot of that. If we buy a $40,000 car for an adult child, even after gift splitting, we need to file a gift tax form for the excess $8,000. Yeah, if you either give a child money or if you give them an asset that is valued at $40,000, then even with gift splitting, you and your spouse will each be deemed to have made a $20,000 donation. So the technical rules require that each of you file a gift tax return showing that you've used $4,000 of your exclusion amount. That's a good question. All right. Can the kids inheriting these split gifts set the cash aside in a trust that is held until death of parents to cover? Yeah. So really fantastic when the family is cooperative, when the parents trust the children when the family has the mindset and the children have the mindset of, Mom and Dad, I appreciate what you're doing for me by doing this gifting, but us children, we all realize this is your money, and we're not going to touch it until both of you pass away, and we realize you're doing some things to benefit us to avoid a 40% estate tax. So yes, that money is just going to be set aside. In fact, the parents can have that money go directly into trusts for the children instead of the children getting the money and then having to voluntarily put it in trusts for themselves. So yeah, that's the ideal situation when the family has a plan, not just a spouse has a plan. So it's great when you get that buy-in from the second and third generations. All right, very good. Parents, not patents. Yeah, I got good old typo there. All right, like your stuff there. Okay, so just check the YouTube channel. By Sunday, I'll have the schedule out there for next week. Going to be talking a lot of retirement account distributions. I almost can guarantee you that I'll be telling you some things that you haven't heard of before. I'm looking forward to that. Y'all take care. Have a good one.